And the worse the headlines get, the more bullish it becomes. And then you get all of the most negative people at 60 and 100 that can't get enough at 250. And then we'll be doing this, and I'm going to be talking, everyone's going to be super exuberant. All the Twitter is going to be China, China, China. And I'll be on and say, yeah, we just sold 20% of our position. You're going to be like, what? You're Mr. Alibaba. Like, how did you sell 20% of your position? I was like, well, it's 280. It's fairly valued. We'll hold the other 80% until people get super exuberant. But that's where we are now. And we'll go back to this video in a couple of years and we'll be like, I can't believe. And I'll say, what do you mean you can't believe? Of course you can believe. If you own the apartment and the rents went up 800%, you would have never sold at $100. And that's exactly what we're talking about here.
Thanks for tuning in again for my friends who are interested in investing in Chinese equities. Days like today are very, very tough, right? Everything's in the red. There's only fear out there in the media. Chinese economic data looking very, very bad. And the sentiment just isn't great. So I've got something special for you today. I think you will all enjoy it. And if you've been listener and viewer of this channel before, then you know already Tom Hayes, which I had the pleasure to just record a 15 minutes interview. And it's full of nuggets around investing in Chinese equities, the Chinese economy, the stock markets in general, and of course, a lot about Alibaba. And this is a quick teaser and spoiler here on the public channel. I still need to cut the whole video, which is about 15 minutes in total, and I won't finish this here while I'm on my holidays actually in Mallorca. And unfortunately, whenever I'm in Mallorca, it's just a fun fact, but every time NIO Stock is so much in the red. But every time as well, I'm also jumping on a call with Tom Hayes whenever I'm in Mallorca, funnily enough. So, this is just the time. And so I hope you will enjoy that. And to my Patreons, you can watch the full uncut video already now. I've already uploaded it. If you're a patron, you'll find it in the network section where I post the new videos. If you're not one of the members yet, you can of course become one. Just go to patreon.com/dongxi, get the $10 tier, and then you'll get the invite link to watch the full video immediately. And so with that, I hope you will enjoy it. Thanks for watching and your support. Tom Hayes, it's great to have you back on the channel. Especially in times like today when the Chinese names are under heavy pressure. Pretty much everything in red, right? I think we have to talk about the Chinese economy, but much in particular about Alibaba stock, which I know you are a big Alibaba bull and you know a lot about the company. So I'm very excited to have you here on the channel again. But Tom, maybe you can introduce yourself quickly to the new followers of this channel.
Yeah, well, thank you for having me, Marcel. I'm Tom Hayes. I run a long-short equity strategy for accredited investors and qualified institutions called Great Hill Capital is the name of the firm. We also do a podcast called Hedge Fund Tips with Tom Hayes. It's the #1 ranked podcast in the hedge fund tips category. And you can find that on YouTube, or you can find it anywhere you get your podcast. The benefit of YouTube, obviously, is you get the visual charts. But many people like to listen while they're walking or running or doing other things. And then we have our blog where we publish a research note every Thursday, which is free of charge. And that's hedgefundtips.com. So we're staying busy these days, and we think there's a tremendous amount of opportunity out there.
And a good point of your YouTube is to also get a little insight into your private social life. I always enjoying that. Tom, how are you doing? Are you sleeping at night with having an Alibaba position right now? We've got plenty of negative data coming in, especially these days, right? Today again, disappointment on the consumer data as well. So how do you stay positive here?
Yeah, no, it's not easy. You just need to put things in perspective. And what I find is to make big money in this business, you have to zoom out. I was looking at Alibaba last night. And if you go back to the period from 2015 to 2017, the last time that it took a long time to bottom, it IPO'd out of the gate, around $80. It went up to $120. It crashed down to $57. And then it just literally took a couple years to recover. But once it got through that 100 and then 120, it went straight up to 200 in less than a year. And I think we're going to have a very similar situation. The difference is this time, the consolidation after the 80 or 90% collapse seems to be happening much quicker. It doesn't appear that we're going to need 2 or 2.5 years to form the base. It looks like we're doing it in about a year and a half. If you think the bottom was, give or take the first, if you're into technical analysis, and by the way, we're not, technical analysis only comes in handy when the fundamentals make no sense. And we're going to talk about why the fundamentals make no sense. But, you basically put in that first shoulder in spring of last year. You put in the inverse head, the absolute bottom, in the fall, and then you put in the new shoulder earlier this year in the high 70s. And now it looks like it wants to work higher. I think obviously the first resistance has been getting through 100. We did it for a few days successfully. Now it's pulling back to 90. And whether it goes back and retests that shoulder at 80 or 78, we don't know. In some sense, at this stage, we kind of hope it does because we have a lot of new money to put to work, but we're not holding our breath. I think the more likely scenario is that this thing works up to 120, and that'll be the next point at where it's going to hit a wall of resistance. There's going to be a lot of overhead supply. And then once it gets through there, I think it's straight up to 180. So why do we even care about these technicals, and why do we look at them when we say it's so disconnected from the fundamentals? And leaving aside the short-term fundamentals, as you know, that the earnings shot the lights out last week. I mean, it was mind-boggling to consider that you basically have a country that experienced a once-in-a-100-year event, as we all did around the world, COVID, but they prolonged it, self-inflicted gunshot wound by keeping people locked up for 2 years longer than they had to be locked up. And in spite of that, the business continues to grow. It continues to flourish, given it's operating with shackles. Obviously, the shackles are coming off as the government backs off because they don't want 25% of their youth unemployed and rioting on the streets. Number one job of a politician is to stay in power. And I think, like COVID, eventually people can take pain for so long until they start to revolt. And what we saw was the rioting in December and January, and all of a sudden overnight, the Chinese government did a 180 and said, okay, if you want COVID, have at it. And they reversed their policy, unwelded the doors, let people out of their apartments, and that was that. And I think we're getting close to it on the general social unrest. You don't want a couple 100 million young, educated, angry people without jobs, and that's what they're facing right now. So they're going to have to come out with the stimulus bazooka. And the worse the headlines get, the more bullish it becomes, because we're seeing these piecemeal kind of operations where they say, okay, we'll lower the reserve requirement ratio by 10 basis points or whatever. We'll lower the amount of down payment you have to put on second homes to 40% from 50%. But this is all nonsense. They need to come out with a massive stimulus boost. And I think Kai Fang, who is a member of the policy committee at the People's Bank of China, had it right when he came out and said, look, you need to do $500 billion and you need to put it directly in consumers' pockets, just like the US did and Europe did, et cetera.
Lots of things to dissect here. The first thing regarding youth unemployment, because you just spoke about it, and today we had the news that China stopped basically reporting it, right? I found this quite interesting, because even as a China bull, which I am as well, I thought like, well, this isn't great in terms of how this will be taken up by investors in order to get a better sentiment and confidence, right? What's your take on that?
Yeah, I think it's like Banana Republic tactics. But the good news is that they realize that there's a problem, and now the question is they're going to have to fix the problem. And I always give people the benefit of the doubt. I have this unreasonable view that people do what's in their self-interest, and in the case of Xi Jinping, it's in his self-interest to avoid unrest and possibly avoid riots and people in the street calling for his removal. And I think I would have figured he learned that lesson from COVID when they started rioting in the streets and he had to reverse his policy. And on that basis, I thought, well, on this, he probably learned something 6 months ago, so maybe he'll be proactive this time versus reactive. It appears that he's not. So on that basis, I think you're going to start to see rioting in the streets. I mean, the Chinese people are smart. They know that he's removing the numbers for a reason. He's trying to cover up a complete failure in leadership. And eventually they're going to take to the streets, because the last thing you want to do after graduating university and having this hope and dream of working for Alibaba or working for Tencent and living an upper middle class life is the government saying, oh, just be pleased with a garbage job, or don't have a job, et cetera. And the government's activity of taking the shackles off of big tech, because they desperately know they now need them to employ these young people, is simply too slow. They're going to have to step on the gas. They're going to have to put it in fifth gear, and they're going to have to hit the nitrous oxide to get this machine going. And I think it's going to be an overnight thing. So for everyone, selling me their Alibaba shares today and other Chinese shares today, I'm very happy for that. But just know that you're going to wake up one morning, just like what happened with COVID, and there's going to be some huge fiscal stimulus or some big announcement, and some of these stocks are going to be up $20, $30, and you're just not going to be able to get in, and they're not going to stop. We don't know when that is, whether it's another year from now or another day from now, but we do know that what we own, okay? And the big analogy I use with a company like Alibaba, which we saw Taobao and Tmall in the worst conditions in a century, up 12% year on year. Growth is back. We saw the international up 41%. We saw the rest of it up 14%. We even saw the cloud growth, which is going to be the future of the company, up 4%. People were kind of pessimistic on that, but they're still working off. TikTok was their largest client, and they're transferring everything over to Oracle in order to stay in the US. So that's a big hit, but their financial spend from financials is going up, from education is going up, from everything else is going up. And we haven't even gotten into the biggest part of the future growth story, which is large language models, and compute power demand is going to literally be unlimited moving forward. And we're going to get that spun out to shareholders. So that'll be a standalone basis that can get a standalone multiple. And rather than trading at 11 times versus its historic multiple of 22 times, we'll have a business that can trade at an unreasonably high multiple on the basis of future growth. So that's that. But under the surface, it's like, how can we have confidence when the thing vacillates? Look, we bought some a lot higher than here. We bought some a lot lower than here. Our last purchase in size was at $61. We have purchases at $120 plus. But at the end of the day, it's when you think about what the sum of the parts of this business is worth, and why would we have such a level of confidence? In our conservative analysis, whether it's 3 years out or 5 years out or 2 years out, we think this is worth 280 to 320 when you add all the pieces back, and it could be worth a lot more if we get aggressive. And why we feel that way is not based on emotion, it's based on data. And the one thing that we saw since 2014 is you had revenues per share and cash flow per share up 500% each. Revenues per share up 800%, earnings and cash flow up 500%, and the stock price has done nothing. I've only seen one instance of this in history where it's been such a prolonged increase in intrinsic value without an increase in price appreciation, and that was Microsoft did the exact same thing from 2006 to 2013.
So this was the first part of the interview. I will release more bits over time here on the channel when I find the time to cut it during my vacations here. And then if you're a Patreon member, again, you can already see the full uncut video now and just watch it straight. But otherwise, stay tuned, subscribe to this channel, and hit the bell button so you don't miss out on any of the other parts of this interview with Tom Hayes about Alibaba, China, and investing in general. So thanks for watching, and see you in my next videos.